Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today's Tuesday. It's February 15th. We're a little bit more than halfway done with February. It's about 7:46. The market's going to open up in about an hour and 40 minutes or so. And as you can see here, we are up big. The Dow, the NASDAQ, the S&P. Usually when you have the NASDAQ and the Dow up, the S&P will be up as well because the S&P is made up of part of the Dow and the NASDAQ 100, obviously. But yesterday we saw really good strength in the NASDAQ, but some weakness in the Dow, and then it went backwards. So it was a very, very fragmented market, and it's been a really fragmented market since this volatility started. But things are looking better. So let's talk about what's causing all of this, what's happening, what's under the hood, and so forth and so forth. And by the way, if I've been helping you stay out of trouble with all of this gyrations, all of this market mishigas, all of this craziness, buffoonery, let me know. Send me an email, support@marketgeeks.com. I told you we're not going to crash, and I meant it, and we're not going to crash. There's nothing supporting a crash at these levels. So the big report, we have the PPI that's coming today. That'll give us a sign of inflation on the producers level, on the wholesale level. We're also going to get the Red Book, which is a same-store sale, chain-store sale report in light of tomorrow's retail sales report, which is going to be massive. Retail sales makes up 2/3 of the economy. And then we've got industrial production, and then we've got FOMC. Expect somewhat a subdued market. And when I say subdued market, it's all relative based on the current volatility. And as you can see here, the volatility is doing anything but being reasonable. So let's talk about why the markets are up. But first, I want to show you the bond market. Keep your eye on the bond market. Notice we're down, and we're down 0.60 for the day, but I want to see if we're going to break this low. I've been very, very smart not to fade this downturn, but I'm expecting the bond market to turn higher, rally till about the 140, 142 level, and then I want to sell the living heck out of it. But I don't want to go against the main trend. Bonds going lower means interest rates are going higher. We're waiting for that to stop. Also, what's really great is put the call ratio closed at 1. We got to look at it. It's 109 minus 9, so it's at 118 closing as of last night. Anything above 1 is positive. And we've been hovering around these levels now for quite some time. This is also telling me that markets are headed higher, not lower. Now, again, the big reports is going to be the PPI. It's coming out in about 42 minutes. Then we've got the Red Book, which should give us some indication of what the retail sales report will look at tomorrow. And then we've got industrial production. I think the PPI is going to be very, very telling because it'll give us an indication of inflation on the producer's level, not on a consumer's level, but on a producer's level. Let's talk about the market. Everybody's focused on this imaginary war between Ukraine and Russia. Folks, I don't think there's going to be a war. Why? Because Putin, we may not like him very much out here in the West. He's anything but crazy. And he's very transactional. He's very money motivated. And anything that would destabilize his position, potentially even 1%, he would not go for. So I think there's a much, 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 much higher chance of things working out between the East and the West than them having a fight over Ukraine, and it wouldn't be much of a fight. And I'll tell you another thing: 50% of Ukraine wants to be part of Russia. They get more benefits in Russia. The wages are higher in Russia. Quality of life is better, and a lot of them don't want to speak Ukrainian. Remember, 30 years ago, it was all one big place. It was USSR, Soviet Union. So it's not like something that's been there for 300 years. It's only been 30 years. Okay, so let's not get bent over shape over this. European benchmark jumped early Tuesday, which is why the indexes are up so much. As you could see right here, Dow up 400 points. As Kremlin and the West held out the possibility of a diplomatic path out of the Ukrainian crisis. Asian shares were mostly lower. Russian Foreign Minister Sergei Lavrov signaled Monday in a made-for-television meeting with Putin that Moscow would keep talking about the security grievances that have led to the crisis. Russia denies its plans to invade, but it keeps pushing, it keeps poking the bear, but has amassed more than 130,000 troops in the border. The comments raised hope that the war could be averted even as the U.S., Britain, and other allies warned troops could move on Ukraine as soon as Wednesday. Everybody's looking at Wednesday. Everybody's talking about the 16th. Folks, if it was such a big secret, why would everybody be talking about the 16th? It's been out there for 2 weeks now. Do you think Putin would do something if everybody's talking about the date? Wouldn't be the attack moment be secret? I mean, you would think, right? Markets were spooked Monday after U.S. said it was closing its embassy in Ukraine and moving all remaining staffers out. And yeah, that was very interesting. Now, Tokyo, they had a rally, ran out of steam. Data in Japan showed an economy grew at an annual rate of 5.4%, which is not bad. Investors have been trying to gauge how the stocks and broad market will be affected by the Federal Reserve's move to raise rates, which I'm very skeptical they're going to be doing 4 to 6 or 7 raises this year. That's just insane. The Federal Reserve, the central bank is expected to start raising its benchmark rate in March, and Wall Street expects as many as 7 rate hikes this year. Yeah, I'll see it when I believe it. After last week's report that inflation jumped 7.5% in January, the fastest in 4 decades. Also this week also brings update on inflation and how that might impact consumer spending. That's one of the things that we're going to see today. PPI, industrial production, business inventories, a lot of data on consumer spending. U.S. Labor Department will release its January report for prices at the wholesale level on Tuesday. That's the report I'm talking about. That's the PPI. And the Commerce Department will release its January retail report tomorrow. That's this right here. So PPI, and remember, if businesses have inflation, obviously it'll trickle down to the consumer. So PPI is very important. Retail sales is of utmost important. Keep your eye on the bond market. Let's talk about levels. Very, very important. Let's talk about levels right now. Now, we're going to have a rally. The S&P is already above the 200-day moving average. We need to stay above the 200-day moving average at least for 2 sessions and not violate it to the downside. I want to see clearance like this. Notice these 4 bars. Well, except for this one right here. Here, let me reduce the time period. Notice these bars. Actually, it's not touching it. It looks like it is. Notice these bars do not touch the brown line. This one almost does, like by 1 tick, but it doesn't. I could see it closer. So I want to see 2 days. I want to see these 2 days or these 2 days. I want to see 2 complete days of clearance. I need to see 2 complete days of clearance before becoming bullish. Now, on the Dow, which has been actually moving really well, we are already almost there, which is kind of interesting because the S&P, the Dow was leading the S&P, and now the S&P is leading the Dow, which means there's some strength moving on the NASDAQ, which we'll go into in a minute. But the Dow needs to go above this brown line and stay there. The QQQ, which has been showing some upside, and I'm happy about that, is still far away. We're still down below the 200-day moving average. We need to see some certainty before moving higher. So I'm going to be very, very skeptical that this rally is going to hold till we do. What is positive is, if you look at, let me just go to the basic stock index here. If you look at the sectors yesterday, and this is positive, consumer discretionary, it says today, but this is yesterday. We've had 3 of the most speculative sectors lead yesterday, which is telling me that the NASDAQ 100 is getting some love out of Wall Street. Now, I want to see if this is going to continue, because if you look at this on a 5-day basis, it doesn't look like that at all. Consumer discretionary is here, communications is here, infotech is here, but on a 1-day basis, yesterday, consumer discretionary, communication services, technology. And when you look at these sectors, technology looks like it can go up to the 165 level. It looks like it's bottoming out. It looks like a 1, 2, 3 double top and a second bottom here. Consumer staples looks like it's bottoming out. Financial looks like it's going to be choppy. Industrial looks like it's bottoming out. Healthcare looks like it's bottoming out. Consumer discretionary actually looks like it's going to, that this is the bottom and it looks like it's going to go higher. Be very, very careful, folks. XLY, be very, very careful if XLY today breaks below. Let me show you these levels here. If consumer discretionary breaks this low, breaks the 179, that's going to be bad. If it stays above 179, that's going to be positive. Write that number down. 179 is the magic number on consumer discretionary, and on basic materials, that number is 82. So on XLY, that number is 179, and on XLP, excuse me, not XLP, what is basic materials? I'm losing my mind. XLB, excuse me. On XLB, that number happens to be 8230. If we can stay above this territory over the next few days, and I'll show you, you're having this on the basic materials, this ascending triangle. Let's see here if I could draw it for you. If basic materials can stay above these levels, if consumer discretionary, let's just adjust this right here, can stay above these levels, there's a chance. There's a chance, and if we go above the 200-day, there's a good chance we'll rally. But we got to make sure that consumer discretionary does not break these levels, and that basic materials does not break these levels. Very, 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 very important. Now, don't be a hero. Don't try to jump into this market. Let's wait for the market to give us clues of what's happening. If we see more relief, that like no war between Ukraine and Russia, we're going to get some good upside on this market, because this market is already pricing in the worst of it. And that's very, very positive. It's pricing in 7 rate hikes, right? Think about this. And think about the big picture as I speak to you about this. Look at the Dow. The all-time high on the Dow is 36,900. We're at 34,000. We're less than 2,000 points away from all-time highs. And the market is pricing in a war, 7 rate hikes. This is not a bear market, folks. This is a market that wants to go higher, not lower. And again, think about where we've been. Think about where we've been. And this is the big point I've been trying to make. Look at performance. Look at momentum levels. We're not on top. We're at the bottom right now. Look at 5 years momentum. Look at this. Look at that. We're not really like up here. If we were up here, I would be thinking there's some bad side. But even if we fall, where are we going to go? This looks like a shakeout. This is a shakeout. This is COVID. This is 2018 raising rates. Typically, though, we don't really go too much below these levels. So I think the market is ready to turn higher, shake out the weak hands. And I've been saying the same thing for a while now. We just have to have crucial levels not broken. And those levels include the 179 on consumer discretionary, and look for major indices to trade 2 days above the 200-day moving average without touching the moving average. That's a major, major sign. Now, I've got a nice little surprise for you folks. Oh, by the way, I wanted to tell you major sector, weakest sector, strongest sector. I forgot. Let's do that right now. Strongest sector remains energy. Weakest sector remains communication services. Let's see if the same stocks remain the strongest. Devon Energy. What, for 2 months now? Devon, US Marathon, one of these two. Strongest stocks, nothing changes. That's why I like to use my CSI scan. Nothing changes. And in terms of communication, PayPal, Twitter, Zebra Technologies, they're just not looking all that great. Twitter and Gap's not looking either. Meta, PayPal, Twitter, just not looking all that good at all. Tech is just not looking all that great. Some tech is, like Align Technologies is not. So you got to be very, very, very cautious. And still, Dish is still down here. So again, if you PayPal, weakest tech communication stock, strongest energy stock, Devon Energy. Now, before I let you go, I've got a treat for you, a real treat. Folks, I've been waiting for this day for a long, long time. I'm not kidding. I really have. Mark A. Latimer and I are going live today at 1 p.m. Eastern Time to talk 1 p.m. Eastern Time to talk about gap trading. Mark A. is literally flying in as I speak. She's flying all the way from the West Coast, and we're going to get deep into gap trading. Now, I've known Mark A. for quite some time, and I've gotten a few chances to work with her in the past. She's one of the most successful chart traders and stock pickers that I've ever met. She sees the market from the right perspective. She's been doing this for a long, long time. Now, I don't think anyone else could have convinced me to overcome my questions about gap trade setups, because I haven't been a big gap trader and I'm very skeptical about gaps. But Marque is literally changing my mind in real time. What she's going to show you will convince you how accurate and how objective gaps can be. And what's really cool about gaps is you're looking at charts, but you're looking at objective data. So it's not lagging behind like indicators, which is really, really important. Marque recently showed me her 120 rebound strategy. Folks, it blew me away. Click the link below to register for our live event at 1 p.m. Eastern Time today. 1 p.m. Eastern Time today. Follow the link below this YouTube video Tomorrow, we're going to talk about one long, one short, actionable trade ideas. Let's keep an eye on this Ukraine debacle, okay? And the alleged 7-time raise rates by the Fed. Register now, 1 p.m. Eastern time. I'll see you there with Marquet. Bye, guys. It's going to be a great one. And stay out of trouble. This is not a time to be a hero. Don't over leverage yourself. But I think we're going to be okay. We're going to get out of this in one piece. Bye.